Okay, good afternoon, guys. Welcome to this seminar this afternoon on oil trading and trading in energy markets. So, might as well get started. Now, before I start, as always, I need to read you the risk warning. Now, spread betting and CFD trading both carry a high level of risk to your capital, with the possibility of losing more than your initial investment. These products might not be suitable for all investors and are only intended for people over the age of 18. Please ensure you're fully aware of the risks involved and, if necessary, seek independent financial advice. Again, this is educational only. The content of the webinar is the personal opinion of the moderator, not intertrader.com. The content does not constitute financial, investment, or tax advice. You're advised to discuss your specific requirements with an independent financial advisor prior to entering any bet. Intertrader.com is not responsible and disclaims all and any liability for the content of comments during this session. Okay, so when we talk about trading oil, and we talk about the impact it has on us as a global economy and for ourselves as consumers, put into these rough figures, okay? Production-wise, we're producing around about 81.6 million barrels a day. And consumption-wise, we're consuming around about 83.7. So as we know, oil is a scarce commodity, okay? There's only so much we're led to believe that's around in the world. So that means that oil is very elastic, okay? It's elastic in the sense that it's very inelastic to us as human beings, okay? So as you can see, petrol prices on average going up by half a p every single week. Okay, so we've got the highest price in the UK of petrol, and this is down to the price of oil and the uncertainty in the markets. So what it means is the elasticity thing, that obviously that it doesn't really matter what price oil and petrol get to, people to a certain degree will always need it. So you think of it like an elastic band. Okay, so elasticity is when it pulls out, we're looking for the extremes of the market, and then when you let it go, that's the quicker it comes back. But with things like oil, petrol, cigarettes, they're relatively inelastic. So it doesn't really matter what the supply is. You know, if the supply is increased or decreased, the demand for it is going to be constant. So what that means when we're talking about trading oil and the energy markets is that things like, because the demand will never really change and always be there for oil and products derived from oil, any kind of shift in the production or the ability to get oil out of the ground and to get it to the countries where it's needed is going to mean there's going to be a big effect, a very, very quick knock-on effect to the price of oil and the subsidiary products. So again, when we're trading oil, we really have to look at the things that make it move. So that's things like our geopolitical events, stability of the oil-producing nations, new discoveries in oil, and all these kind of things are going to make the oil price move. So when I listened to the previous speaker, and I think a couple of points that he made were very interesting. It's always good to keep your trading strategy simple as you can, with as little complications. But he was saying that he traded just the figures without market information. Okay, so really, what I would say is that when you're trading oil and any real kind of commodities, that you have to be aware of your technicals, okay, your levels, your daily levels, your ranges, but you certainly have to be aware of the fundamental news that's driving the markets, okay, and especially in oil. So as we go through this presentation and we talk about the different factors affecting oil, I think it becomes quite apparent that if we don't understand what's happening in the world and we're not too sure of the actual fundamentals, oil trading can be very, very risky. So when we talk about oil and how it's traded, we generally talk about it in terms of barrels. So these days, again, it's an old-fashioned term, but this is still how it's referred to in the markets. So 1 barrel is generally equates to 42 US gallons or 164 liters. Okay, so that's how the product is traded. It never really sees the inside of a barrel these days because the pure demand for oil, it's shipped through pipelines and huge containers. Okay, but again, it's just being aware of the market talk, the market lingo, etc., etc. So we know when we talk about a barrel of oil, that's what it equates to. Now we talk about the production and the transportation of oil. It becomes quite clear from this graph that the cost of production, okay, is directly relative to the price of oil. So the easier it is to get out of the ground, and the more abundance there is of oil, the cheaper it's going to be to produce, to refine, and to get out to the nations and the countries that need it. So we look at this graph. What we can see is that straight away Saudi Arabia and the rest of the Middle East take up 2 pretty substantial blocks of of countries that can produce oil at a relatively inexpensive price. Then we have Russia. Okay, then we've got our smaller blocks like China, Libya, Mexico. Then we have a bigger block for the rest of the kind of civilized world, should we call it, South America, Europe, Asia, and Africa. So again, this graph really kind of illustrates that when we're talking about geopolitical events, we're talking about the countries that produce the bulk of the oil that we consume as a planet. That we have to keep an eye on what's happening in these governments, what's happening to their stability, what's happening to their ability to produce oil and to keep the constant demand being met. So again, when we talk about places like perhaps America, Europe, they're quite stable. Okay, obviously in Europe we've had big problems with the debt ratios, but that's just monetary policy. That's just, physical transactions in money. That isn't the ability of a government to not function, or the ability for countries not to physically turn up to the jobs and produce and pipe oil. So again, when we talk about countries in the Middle East and places like Russia that are probably a little bit less easy to determine how stable they are, and when we talk again like places like Libya, it's been quite apparent in the news that the tensions between the rest of the world and Libya with regards to their nuclear program could have an ability with sanctions to stop Libya being able to get rid of its oil supplies, to maintain this, although it's a small chunk on the graph, a small slice, when we talk about in barrel terms and real terms, again, we're talking about millions of barrels a day that are coming out of Libya, supplying to the market. So when the sanctions were imposed and have been imposed, like again in Iran, and other places, that what will happen is that obviously they will need to offload their oil to somebody else, and if they can't, then they're going to sit on huge stockpiles, and that's going to affect the price of oil. So again, when we talk about oil, we're really generally concentrating on Brent. Okay, so Brent is a global benchmark for crude. Okay, it's a blend of over 20 fields, and it's exported from the Suleiman oil terminal in the Shetland Islands. Okay, so Brent production, it is declining, and it's what we kind of really put in barrel terms is less than so these figures say 220,000 barrels a day. So it's still huge when you talk about it, but then you have to look at things like oil supplies, you have to look at oil reserves, and all these things, if you do build out a map and a picture, are going to help you trade oil, in the best way. So we're going to come to some slightly different techniques towards the end, things like arbitrage and trading different oil markets against each other. But right now we're just going to concentrate on why oil is such a very, very volatile product, and why it's a great product to trade if you like reacting to fundamental news and you like markets that generally move in one direction fairly quickly. So again, there are other types of crude that we can trade. So you may have heard of these. So again, we have the Kuwait crude, the ones that come out of Dubai, and we have the Bonny, which comes out of Nigeria. So again, when we talk about countries that are stable, Nigeria historically has not been the most stable politically of countries. So again, if people are looking for that to be a part of the whole makeup of the oil market, then that's something we can focus on. So we talk about the benchmark, obviously we're talking about crude. So we can look at the difference in the price between these three other types of crude and Brent. So the difference really does range between $3.7 and $6.25 according to these figures. These are just for illustration purposes. They're not real-time data. So again, there's all different things we need to look at and really be very conscious of when we're trading these oil markets. Okay, so we're going to see a little bit later on in the presentation how these particular oils are broken down, because it's generally not the oil we want as a whole. What we want is the component parts that we break down for things that we use in everyday life. And again, when we break them down and look at it, we'll all begin to build up the bigger picture of how massive oil is and how completely, and let's not be under any illusion, how completely dependent we are as a planet on oil. There may be substitutes for different types of energy, but if oil ceased to exist tomorrow, the world as we know it will pretty much come to a standstill in a matter of days. So when we talk about other types of oil, you may have heard of the WTI, which is the West Texas Intermediate. Okay, so this is a composite blend that emanates out of West Texas, given it its name. Okay, so again, it follows the benchmark of crude, Brent, And again, delivery is at Cushing, Oklahoma, in the middle of Texas, and it's pumped through the U.S. oil pipeline system. So again, it's a physical crude, and it's used as the basis for NYMEX light sweet crude contract. Again, something we should have heard on exchanges like the API and ICE, etc., etc. So again, when we talk about oil and we refine it, we really want to get the products and make the subsidiary products from the actual oil that we're refining. So again, it really is, we have to think about this, and not just for the products we're getting, but how these things are used on a global scale. So again, things like liquefied petroleum gas. So again, it isn't just places like the US and the UK that need this. We have huge continents, like Russia and China that use these kind of things. So think of the scale that that's produced on. Then we have different chemicals, things like naphtha that we use in roads. How many roads are there in the world? Yeah? There's no country in the world that doesn't have roads, that doesn't need, this derivative of oil to be able to make it. Then petrol, as we've already identified, petrol's on a direct correlation with oil. And although even when we see a drop in the price of oil, petrol never quite seems to mirror that. That if we do see a big drop off in oil, it takes a long time for that to filter back into the petrol market and bring the prices down, if at all. So again, something when we talk about other bigger factors in the markets, we talk about our CPI, Consumer Price Index, and our PPI, our Producer Price Index. Okay, so they're things that are a measure of inflation. So when we talk about Consumer Price Index, generally what we try to do is look at the Consumer Price Indexes without food and oil, because they're so volatile. But again, if the prices of oil keep going up and petrol keeps going up, it's actually affecting people's lives. So that becomes a factor within inflation. So then we have to look at the wider economy. How do we control inflation? We raise interest rates. Okay, so the UK have not moved on interest rates. The EU have not moved on interest rates. If anything, they've cut. And the US has committed to keeping interest rates on hold until 2014. So if petrol prices keep having to rise, what's that going to have effect on the global economy? What effect is it going to have on the US and Europe? Are we going to have to put up interest rates to try and control inflation? If things like petrol and the cost of food production and how it's transported, again, puts a too heavy a burden on inflation. So these are all the things we have to think about. So when we talk about oil, we're talking about something the world, everyone in the world uses. So it filters through to everything we do and every other market we trade. So that's why oil on its own is a very interesting contract to trade, because it does have an effect on everything, literally everything we do. So then we can go into the big things like jet fuel. Okay, we all know that planes need fuel to get around, as do trains, especially the diesel ones. Then we can have our different products like a lubricated waxes. Then again, our ships to transport this oil, well, they have to be powered by something. Then again, we have things like roads, bitumen for roofing. All these things that everybody can see around them are all derived from oil. So that's how huge and how massively important this contract is to the way we live our lives. So refining crude. So again, the major products we're trying to get out that we use every day and that the oil is most important for is things like LPG, okay, gasoline, our petrol, our kerosene for the jet fuel, gas and diesel power for generation and heat, and fuel oil again for heat and shipping fuel. Then we get our specialty products like naphtha that we said for roads, our lube oils and waxes that we see every day, our bitumen for roads, and again coke. So when we talk about refining crude and the distillate yields we get, okay, we've just talked about the things that are important that we use mainly from oil. Well, this kind of breaks it down into a bit more kind of manageable. So we can, again, put a bit more emphasis on why the market would want WTI, our West Texas Intermediate, why the market would want Brent, and why the market would want Saudi Light. So you can see that when we distill these particular barrels, and as a percentage-wise, then if we look, then we get slightly different figures, okay, from what particular oil it is and what we actually get yield from it. So if we let's take fuel oil for instance. So as we know, Brent is the benchmark, is the easiest to obtain and easiest to refine. However, So what would happen in the market if Brent suddenly became very hard to get hold of, but there was an influx of Saudi light? Then the market would shift to Saudi light, yeah? Because the world still needs fuel oil. It still needs that particular product. But if Brent's taken out of the equation, yeah, then the price of Brent would obviously drop because it isn't available. Or, I mean, again, it's quite a difficult one to explain. Obviously, if there's no Brent or a really diminished supply of Brent, the price would obviously go up. But if it ceased to exist, for instance, which it never would in this example, but it would become valueless. So obviously the WTI and Saudi would massively increase in price. So what I'm trying to illustrate from this is that although we've got the benchmark market of Brent and the Saudi and the WTI will follow it, they don't follow it price to price. Okay, so the price of Brent will not be the same price as WTI or the same price as Saudi. So this is what we get when we call like correlations. So the other products will follow and mirror what Brent does, but at a different price. So this is something we're going to move on to slightly later in the presentation when I talk about we can trade different oil products against each other, yeah, in an arbitrary fashion. So we can have different products that follow Brent and mirror, but at different prices. So we can take advantage of that difference and that movement. So again, when we talk about what's important, maybe there's an influx, the economy recovers tomorrow, and China decides it wants to make 300 million miles of roads. Okay, just a crazy example. So maybe the demand for naphtha and products that go into making roads suddenly goes through the roof. Okay, so WTI actually yields more of that particular product than Brent. So maybe the market will then look to buy WTI because they know that's going to be in demand, yeah, and the price goes up. So these are different things we need to look at and need to explore when we trade in the oil markets. That's what makes it slightly more complicated than just trading our stock markets or our bond markets. So futures trading, again, something very important when we're talking about commodities. They always have a big presence in the futures market. Now this is because they are actually a physical delivery. So if you're somebody like Richard Branson, who owns Virgin Airlines, for instance, if you know that the price of petrol is going up, the price of oil is going up, maybe for the next year, you want to lock in that you can fly your fleet of planes around the world for the next 6 months. So maybe you go into the futures market and you buy a block of oil to allow you to fix in your average price for the next 6 months. So again, these are things you need to think about. If the oil price is set to rise and petrol is set to rise, the big shipping companies, okay, the big haulage companies, people that obviously run airlines and big rail industries, are they going to go into the futures market? Are they going to try and lock in an average price by going into the market, locking in what they know is a future price, a future bit of value for them, and then being able, if they need to sell that on, or physically get the oil they need? Yeah. So this is something else you need to look at when you're trading the oil market, the gas market, anything like that. You have to look at what the future prices are doing. What do the future markets expect is going to happen? What's been priced in? So again, we mentioned earlier on your technicals versus your fundamentals. So okay, we'll talk about things like Dow's theory, that the market discounts all news. Yeah, that's very much like Adam Smith, our other market economists, that all the information at any one time is known, and that's why we arrive at a price that's the market. So it's only when new information comes into the market does the price of oil change. Okay, so the two main things, as I've just mentioned, that are going to affect the price of oil are things that are going to affect a country's ability to produce oil, and things that come out of the US, especially by the IEA and the Department of Energy, about the relative stocks that the US hold of oil, and again, what their production figures are. So all these things, what we class as fundamental information. So if they come into the market, yeah, they will move, especially in the futures market. These markets are a lot quicker and a lot harder in one direction, yeah, than most other markets. So we have to be very aware of our technicals, our daily ranges, our key levels, what the market's saying to us. But we have to make sure, in my opinion anyway, that we know what's happening on the news wires. We know when, especially the Department of Energy figures are coming out, and we know what effect it's going to have on the price of oil. Because these are the things where we're going to get the edge. There's no one system that works for oil. There's no one system, I don't think, in my opinion, that works for any product, time and time again. You have to make sure that you're in tune with the market, that you have some idea of where it could move to, and adapt your strategy to what the market is telling you. Because again, if there's one strategy that always yielded profit, then eventually everyone would find out what it was, and they would stop working. So, again, it all goes down to your personal preference, how you want to trade the markets, how longer term you want to take your views, and I suppose ultimately how much money you want to make. So, again, as we've already identified, that the oil markets are quite volatile and can move very directionally, very quickly. Yeah? So we need to be understanding what the fundamentals of the markets are, where it can move to, and again, what drives it, what fundamental information. So we have, again, on InterTrader, as we do on any other site like FX Street that provides up-and-coming figures and speakers, we have the Department of Energy. Okay, now they release weekly stock figures every Wednesday at 10:30 New York time. Yeah, and they show us black and white figures of what's coming out, what the Department of Energy says their stock figures are, what they're holding in reserves in case anything happens. So if anything did happen in the Middle East or did happen to the supply chain of oil, then the Department of Energy can step in and supply the market with stockpiles of oil that it holds. So we need to understand where these market figures are coming out, what they mean to the oil price, and again, how we can trade off the back and make money. Right? So again, we have the API, the American Petroleum Institute, and they also release weekly stock figures every Tuesday, 4 o'clock, New York time. But again, it says they're largely ignored by the industry. Well, not now. No figures are ignored by the industry. Some figures don't move as much. Yeah? But these are specific only to oil. Yeah? So the DOE and the API are just for oil. So again, when you have things like non-farm payrolls, that you'll be able to watch me trade on Friday, okay, that applies to every market. We hear non-farm payrolls, if it's significantly out of line, every market will move accordingly. But these oil event calendar figures are only really have a major effect on oil. If they are massively out of line, they can filter through to the currency and the stock market, but generally not. So again, when we talk about planning and being prepared as a trader, we need to know if we're trading oil, what these figures mean to oil, yeah, as in directional wise, and also when they come out, so we're prepared for them. So again, just a bit of a snapshot of when the figures come out. Again, you can find it on your economic calendars. I'm not going through them now. And again, we see our economic calendar. We see all the kind of figures we generally see. The startup for importance. And again, the oil figures are just startup just like this on the economic calendar. And they're that easy to find. So there's no excuse to be trading while these figures are out and getting caught on the wrong side of good or bad fundamental information. Okay, so there's other main economic events also which can have an effect on the oil price. And as I mentioned, non-farm payrolls. Non-farm payrolls is still the biggest figure that comes out of the US. The US is still the biggest consuming nation. So these are things we need to look at. If there's particularly good non-farm payrolls and we're getting a lot of jobs added, is that going to be good for the economy? More people are going to be buying cars. More people are going to be going down to the shops to buy things. Is the demand for oil going to go up? Yeah, and vice versa. So you have to have a take on this. Because again, it's another opportunity, if this is your chosen product, to position yourself and to trade off the back of it. Yeah? So oil contracts. So again, to try and get a relative understanding of what we're doing, okay, a WTI, one lot that you'll be trading equals about 1,000 barrels. Okay? So there's no real max size, it depends on your account, and your P&L moving, the underlying value, one lot generally relates to about $10. So your Brent, again, the same kind of size and the same kind of movement. Then we look at gas oil, that's 100 metric tons. And again, that's quite a bit more expensive. It's 0.25 a dollar, so underlying is $25 a tick. So these are things, again, you have to be wary of. In relatively terms, they're quite expensive contracts to trade, and that's due to the volatility. Okay, so you can't get bigger size off because the markets can extend very quickly in one direction. So you have to pay for that privilege. So these are the things as well you need to look at when you put your capital into your accounts and you're managing your intraday stops and your overall risk-reward ratios, that you're aware of how much it costs to trade each contract, yeah, and the underlying value. So what's important when absorbing the information from weekly and monthly reports into your trading strategy is, again, as we always say, to look at the market's perception. Yeah? What's the market sentiment? So we have to understand, just because these figures come out, what's that have an effect on the bigger picture? Okay? So it's like a lot of things in the economy. A lot of people ask me that when certain figures come out, let's use non-farm payrolls, for example, if it's good, the market can, like, if you're trading the S&P, for example, the S&P might come off, yeah, before it goes up, yeah. So these are all the different things we need to take into account. So even when we get figures from the WTI and the DOE, the API, sorry, and the DOE, just because they may not be as good as the markets expect, doesn't mean the market's always going to go directly in that direction. It's okay. So what I mean is, if the Department of Energy come out and they say that, yeah, stocks are low, so okay, we think that's a negative thing. Yeah, if stocks are low, if anything happens to oil, then there's going to be less supply into the market, demand will stay the same, price will go up, so that'll make the price of oil go up. Not necessarily. There might be a reason that we're not keeping supplies of oil. Maybe the agencies think that the world economy is stable. Maybe they think that that there's plenty of supply to go around, demand's being met, so not having to keep these huge reserves, you know, and these huge sums of money, you know, held on ice almost. So again, it's how the market anticipates it, and it's how we are in the global scale of the world. Remember, we're a global economy, so we're looking at what China's doing, what India's doing, what the Far East and Middle East, you know, what everybody's doing to try and protect our own individual country and our ability to be able to fill our cars up and be able to use oil. So that's what's also very important. Understanding how the market perceives data and how it will react on the back of these figures being released. Yeah, because it isn't as black and white as just trading off good news, bad news, and expecting to go in one direction. So again, it's important to assess the impact of stats against the current market news. Okay, so it'd be foolish to sell Brent on a bearish IEA report if civil war had just broken out in Saudi Arabia. Okay, so the reports can be superseded by what's happening, yeah, in the wider world, you know, in the economy. So that's the things we, you know, again, I keep trying to hammer home that we have to be aware of the fundamentals and what's happening in the world, what's happening in the news, because this is what drives the oil market. Fear. Yeah, if civil war has broken out in Saudi Arabia, fear. We will not get as much oil as we did before. We're going to have to find it for somebody else. It's going to get more expensive. That's a knock-on effect to the economy. Ramp up inflation makes everything more expensive. Yeah, that's how big it is, global terms. Right? So again, I keep emphasizing this so we understand that we're not just trading the price of oil, we're trading the world, yeah, and the world's economy and its expectation. So again, when we talk about the stock figures, yeah, this is, again, is the size of moves we can get when these figures are released. So as we can see from the example, we have a fairly sideways move. There are quite a few hefty red selling candles, and we get to here. When the market data is released, look how far. The market doesn't just retrace at 100% if we're doing a Fibonacci move. It actually retraces probably 50% again of the move. And that's just off the release of these Department of Energy stock figures. So we can turn a bearish move into a bullish move very, very quickly, just by the market interpreting this information. So that's how big it is. Yeah? So again, these are the reasons we have to look at our fundamentals, and people that say you just discount them. That's fine. But if you want to make money and you want to be successful in trading, you have to balance out your fundamentals and your technicals. Yeah? Not equally. Yeah, we're all going to have our bias. But if you're not looking at both, then really, in my opinion, you know, we're trading blind. So we spoke about before the ability to arb. And when we talk about oil is quite a unique market in some ways because everything follows Brent. Okay, so we talked about the WTI and we talked about the Saudi. So there will be different contracts trading at different prices, but they will pretty much at all times mirror the direction of the of Brent because that's the lead indicator. Okay, so what we can do is set out and use our capital in a little bit more of a proactive way and then buy one against the other. Yeah? So you can buy the leading indicator or the underlying indicator and then sell the opposite side of it. So it's probably easy to look at the graph. Okay, so blue is our Brent and black is our WTI. So as we can see, this is a fairly shallow move that moves into quite a bullish increase in price. So we can see that the lines pretty much exactly mirror each other in the direction of the market. So when Brent tops out at the beginning of the graph, so does WTI, so does Brent. So what happens is that we start to get this correlation, yeah. And again, when they're together, we don't see many opportunities. The closer the lines they are, the less divergence we have, and the less opportunity we have to make money. Now, as they start to spread apart, as we can see around about January the 16th line, these are the opportunities that we can buy one and sell against the other. Okay, so generally, what we can do is we're going to have a divergence. Is sell one, then buy the other against it. Okay, so we're automatically maximising our capital because we're going long one contract while shorting another. So what we generally do in this period is when we do see the lines cross and start to move apart and give us that period of divergence, we buy the Brent, okay, which is the lead indicator, and then sell the WTI against it because that's a weaker contract. So what we see is around about the 16th of January line that Brent starts to go up, but obviously so is WTI, but because it's a lower price and because it's moving in the same direction, but that difference in price, we're making the difference. So we're buying underlying, selling WTI, and we keep the spread, the difference between them. So as we can see, you know, we get this really, really huge gap around about February the 15th that we could, you know, again, if we'd have stayed long Brent and short WTI, we'd make all that difference in profit. And again, we'll be taking out the risk, okay? We'll be taking out the risk because we're buying one contract and selling against another. So really, our position is relatively small within the market. So what you can do is you can buy and sell these two contracts on their own. Or there is an actual ARB, an actual physical product called the ARB, that you can trade, go long or short itself. So again, it's just another way of using the capital. It's a different way of trading. And again, it's something that's quite interesting. It doesn't always come apart so aggressively. You might have to pick and choose the way you trade this. But again, it's just like anything in trading terms. Nothing ever works constantly forever. Sometimes you have to be patient. You have to sit back. You have to wait for these opportunities to present themselves. And when it does, you go in hard and you try and make as much profit as you can. So again, we're currently seeing in this example that Brent trading at an all-time high against WTI. Okay, so it's been as high as a difference of $16. So that again, you know, that's our profit. That's how much we can make between the spread. And if you think about that in real terms, $16, that's absolutely huge. Taking on a lot less risk by arbing and splitting your capital. So again, back to this example, it's just for educational purposes, not real data. Okay, as in live data. So again, this was due to an ample supply of Cushing in the US, which is a reference point for WTI. Yeah, a new pipeline is built from Canada, and a huge new storage space is also under development. So again, this means that there'll be more supply for WTI, therefore it goes down, and then Brent because that's still the underlying contract, yeah, and the benchmark is still got the same demand, so carries on to go, yeah, and be stronger. So that's an example of using a technical way of trading off the back of fundamental information, yeah. So again, just because oil moves very directionally and it is so sensitive to fundamental information, this is just a different way of getting a bias and then putting a technical trade on. So really, oil is one of the most volatile contracts. Now, we talk about currency pairs in the FX markets quite often. They are the most liquid of markets and by far the biggest. Roughly $4 trillion is traded every single day in the FX market. So it is huge. But oil is probably still and remaining the most volatile and susceptible to fundamental news. So if you like trading in this way, you like trading off the back of geopolitical events, stock numbers, physical numbers from the API and the DOE, then these are the things that are going to make oil a very attractive product to lose. So again, I mean, the obvious point is don't risk more money than you can afford to lose. That applies to any market and any style of trading. But oil, with it being so directional and so violent when it moves, you can find yourself, if you don't use stops, okay, you will get caught out, and you could end up losing, a lot more money than you put on. So again, when you take a position, it's always prudent to use stops, so you can exit a losing trade to give you the capital requirements to trade another day. There's no point, again, unless you're looking at your screen constantly, trading oil without stops. Because if you're not paying full attention and you're not looking, if any of this fundamental information does come out, you can be on the wrong side of a point move within a matter of minutes. And these are things that make oil great to trade on the right side of it, but very, very dangerous and very unpredictable when you're on the wrong side of it. So really, as a summary, the oil markets are a fantastic tool to trade due to their volatility. The reaction to news, again, is available to us all. We all have the ability to squawk through InterTrader. We all have the ability to read things on the wires like Reuters and Bloomberg. FX Street, of course, is a wealth of knowledge. And again, we have Sky News. We have anything. If anything big happens in the world, the likelihood is we're going to hear about it very, very quickly. Yeah? So again, there's news that affects different regions. So again, we can trade Brent for news that comes out of the US. Again, the Arab markets for the Saudi. Again, the news coming out of these countries will not affect these products in the same way. Okay, so we have to look at that again, especially from an arbitration point, that if something good's happening in the US and something bad's happening in the Middle East, Brent will go up, Saudi will go down, and we will get that difference, divergence between them. That's another opportunity to make money. So again, the supply and demand of different products, again, give you the opportunity to trade. If things like crack or gasoline became, again, completely obsolete and we couldn't find any more, we'd have to rely even more on oil, pushing the price up. Okay, so again, these are just different things we can speculate until the cows come home. But it just shows you what a huge product it is and how we have to be in tune with our technicals and our fundamentals to stand a realistic chance of making a profitable career out of trading oil. Alright guys, we've got a few questions coming through. We've got 15 minutes, so we've got plenty of time. So, Mookie, hello again. Where does oil fit into Forex? Okay, well again, you can put oil into a category of where it's refined, where it comes from, where it's produced. So we're talking about Brent, then we're talking about Brent is quoted in dollars. So if there's a major influx in the oil, perhaps we find the biggest oil field we've ever found, then people will be buying that in dollars. So maybe there'll be more demand for dollars because obviously there's more oil out in the markets and more people will wish to buy it. So they'll have to change the currency into dollars in order to buy it. So that's an example how it can affect the Forex market. Remember, think global. Think the bigger picture. Oil is used by everybody. So try and fit it into the oil, where it's produced, and what currency, that particular country uses, and will there be a bigger demand for that currency or less? That's how you apply it to the Forex markets. Where do I think WTI is going to go? Well, again, people love to ask me these questions. I'm not the font of all knowledge, unfortunately. I do tend to do okay and make money, but you have to look at the underlying factor. If we believe everything we're told by the oil companies and we're told by the government, then oil is a scarce commodity. You still keep pumping it out and putting the price up, but at some point it's going to run out. So until they come up with a solar cell, a hydrogen-powered cell, then the overall trend for oil is always going to be up, bullish. And you can't really look past that. There will be corrections as any market, but generally I would say the trend is up. Okay, the Canadian yen, more correlated with Brent or with WTI oil contract. Oh, well again, we talk about, Canada, very close to America. Yeah, so they're going to buy their oil from America. Japan, again, it relies on different sources. It relies more on, again, from places like Saudi Arabia and the Middle East. So, I don't know if it's more correlated, to be honest. I couldn't honestly answer. I've not got the charts up and I haven't looked at that particular correlation. But again, what I would say is that Brent is the one that most countries, if they have access to it, would buy because it's easily refinable, therefore cheaper. Yeah, and again, that's the reason why it's the benchmark, because it's the easiest to manufacture and break down to the products we want. So again, good question, but I'm not entirely sure I can answer it correctly without going into more research. Let me look into it, and I'll post something up on FX Street. Okay, can one arb with the same broker, or do you need separate ones? No, of course. I mean, you're trading different products. So if you're arbing something, you can use the same broker, of course. They're two different products. They have to be two different products. You can't buy and sell the same contract against each other, unless you did the underlying cash market against the futures. But I wouldn't recommend doing that. So yeah, Miss, you can do that on the same same broker. So your first question. Why is there a shortfall of 2 million? I don't know. Why do you think, Pookie? Why do you think there's a shortfall? Why on earth would people that produce oil want to keep more oil being used than they actually produce? Why would they want to do that? Anybody? Anybody like to help us out here? No? No one got any thoughts? Price going up. Exactly. If there's fear in the market and there's obviously less supply into the market that's being used, yeah, and we're over consuming against what's produced, it automatically, artificially keeps the price high. So governments are happy because they keep the tax. These poor oil companies are happy because they make $1 billion every month, or whatever it is. So everyone's happy, apart from the poor consumers that need to fill the cars up or use these products. So that's why there's always a shortfall, because the people that put oil into the markets, yeah, they're an oligopoly. They control between them what we use. Yeah, there's no, coincidence why Roman Abramovich is worth what it is, because he knows he's got all the oil he wants and he can sell it at whatever price he wants. So that's why there's always a shortfall. So yeah, brilliant. Well done, guys. Very astute. I'm glad we could do that. Okay, oil has an elastic supply-demand curve. Yeah. Okay, that's what we talked about in the very start of the presentation. Elasticity and products that are relatively inelastic. And that's the important thing we have to remember, that things like cigarettes, oil, etc., are all very inelastic. Yeah? Because it doesn't really matter how much is produced, there will always be a market for it. And again, if the price does go up, therefore, when price goes up normally, most products, you see a fall in demand. But things that are inelastic, essential to human life, or essential to our so-called way of life, yeah, then there is always going to be demand, right? Yeah, plastic also comes from oil, yeah. Okay, I've just got a question from Nando. Reserves are fast diminishing and producing countries want constant high prices for any stock to be extracted. Yeah, absolutely. I mean, that's a very valid point. Yeah, I can't say anything against that. But it's just like anything. Once it runs out or we find an alternative, then we do. So yeah, I guess these countries are making hay while the sun shines. You can't blame them. But is that really giving the people of Earth, a good quality of life? I don't know. It's a very difficult one, very contentious. So I don't really know what to. We could go on a conversation or a political argument for as long as you like on that. But yeah, that's a very straightforward statement, and I agree with it. Okay, looking out to the long term, could WTI and Brent disconnect even further if the US can't sort internal oil transportation? Yeah, I mean, again, when we talk about these things, they're absolutely huge, and the governments are very aware of the ability to transport oil, refine oil, etc., etc. So yeah, I mean that could be something that would lead to a disconnect between the Brent and WTI. But again, these are the things, again, Gamma, if this is what you're interested in, these are the things you need to be looking at, because you can build a long-term bias and then position yourself in the markets accordingly. So if that does happen, and you start to position yourself now, then, 6 months, a year down the line, you could be, heavily on side. And this is what makes oil such an interesting contract to trade, because, you are being a complete economist. You're looking at the world as a functioning global economy and picking out the trades on the back of this. So, waiting and watching. Yeah, good man. That's a great observation. Hadn't thought of it like that. That's a really, really good observation. And yeah, these are the things you need to be building into your strategy. Again, everyone likes to just jump on the back of an intraday trade and make some quick money. But you can position yourself now for maybe the next 5 years. And if you're right, and happy days, with time to go out and buy that yacht. Alright guys, any other questions? Anything we'd like to ask? Again, oil is such a massive, complicated contract, and the way it's built up, it does take some research. If you want to just go and trade off the back of technical levels, then, it's a very difficult product to trade. My experience of trading oil is pretty bad, to be honest. I didn't have a great time when I traded oil. I made money, but it was stressful. When I managed Snyder's in London, possibly the biggest trading floor in Europe now, the only guys that traded oil were people that did it as a team. Okay, so 5 guys that are massively secretive, and they trade spreads, condors, all these different arbitrages against each other's trades. So there's a team of 5 people just to trade the oil. It's that complex. So again, think about that when you're going into the oil markets. These are the guys you've got to compete against. Okay, am I talking in consideration of the availability in the new energy type produced in the analysis of the oil market? Well, again, we can only speculate on what's happening. I don't know, what new sources of energy are going to come into the market. Again, we've seen the solar farms, wind farms, etc. They're going to keep up with production of the ability to produce energy? Probably not. So I don't know. But again, you've got to think to yourself, who are coming up with these new sustainable types of energy? Who are they backed by? Most of them are backed by the oil companies. So again, you have to be a bit cynical, and you have to be a bit, again, take a step back from what you believe in the papers and form your own opinions. So who knows when new renewable energy will come out? Again, with the human race, all we keep doing is progressing and making things a reality. So will there be a substitute to oil at some point? Yes, there will. I can hand on heart guarantee say that. Will it be in my lifetime? I've no idea. So that's how we have to look at it. Okay, so good question. And I do take these things into consideration. However, oil is still a scarce enough resource, and there's enough data available on what we know about oil just to trade off the back of that. Okay, I wouldn't personally take in other factors just yet. But it's not to say we shouldn't do in the future. But yeah, great question that. Very good question. Buki, all charts work in the same way. Know this. They have highs and lows, trends, candlestick formations. They're all the same. The charts are exactly the same for whatever product. Okay, well again, people might disagree, but we're all entitled to our own opinions, and mine's as valid as yours is. And I would never discount anyone's opinion. That's what's great. That's what makes the market and makes it so exciting and so great to trade. That's why we're all here, guys, because we've got that interest and we love trading. And having your own opinion is just as valid and important as anybody else's. But yeah, great comment. Cheers, Cam. Okay, Pitbull, any broker platform you recommend for trading oil? Well, I'd have to say InterTrader, wouldn't I? But no, there's no one I can particularly recommend, to be honest. Just try and find someone with the tightest spreads to allow you to get in and out of your trades as quick as you can. So I'd always look at the spread prices of oil. And again, because they are quite volatile and expensive, they generally can be a bit expensive. Okay, trying trader, what's the next big trade? The next big trade is non-farm payrolls on Friday. Which, again, I'm up money in 5 out of 6 non-farm payrolls. Come and watch me. I'm not guaranteeing I'm going to make money, but I usually do. Or do you mean what's the next big trade in oil? I don't know. Inform me, trying trader. Cheers, I'm guessing you're taking about in general then. Okay, does Oil does move great, but has numerous spikes. Yeah, of course, Fernando. Yeah, oil. But again, because it's so aggressive, we have big moves up and then big corrections. So as fast as it'll go up, you'll see maybe a 50% retracement of that initial move very, very quickly for profit taking, because no one likes to be overexposed. So you'll see the market spike, yeah, a lot more in oil than you will do in things like the FTSE, the S&P, your bond market. That's why it's more expensive, because it moves quicker and it's a lot more volatile, a lot more difficult to contain. Okay, currently green energy options are heavily subsidised and still not competitive in terms of pricing efficiency. Absolutely. And again, remember the governments 5-10 years ago were happy to put as much money as they could into green energy because we were saving the planet. Does anybody care about saving the planet right now? No. Everyone cares about saving the jobs, putting food on the table, filling the cars up. So green energy is taking a backseat. Not to say it's not still important, and we'll not come back into the agenda very soon, but, again, you have to remember about these cycles of the economy we're in. When we have all this money to give to the places like Spain and Portugal to make these massive wind farms. Yeah, that's back when we had money. Now we don't. So these are things, again, we have to look at business cycles, economic cycles, and what's happening in the bigger picture. Yeah, there's no coincidence that oil is making new highs all the time. Okay. Okay, Fernando. Oil consumption for electricity energy production is small, but used for transport, it's electrical batteries that one day will change the scene. Yeah, I'll agree with that, Fernando. Or will it be hydrogen cells? Or will it be compressed gas? I don't know. I'm not a scientist. I'm a speculator. I'm a trader. So I don't care what it is. As long as I can understand and make money from it, who cares? But yeah, great comment, Fernando. Brilliant. What do I think of Canadian sand oil? I don't think anything of it, to be honest. Again, I mean, everyone looks for their edge and looks for, things that are kind of a little bit out there, but I stick to what the market's telling me. I stick to Brent because everybody's trading it. It's the benchmark, and that's where the money is. So, yeah, I don't really look at things too obscure, to be honest, because the momentum and the ability to trade it isn't there for me. So I don't think anything of it, to be honest. If it works for you and you can chart it and you can find your edge and some information about it, that's great. But to be honest, it's not for me. Well, I think of the majority of seminars I've had, this has certainly produced the most questions. It's been great, guys. Yeah, it's been absolutely brilliant observations. It's great questions. Yeah, I hope this bodes well for your oil trading careers. You mean the future of it? I don't know. I don't know anything about it, to be honest. So I can't make any informed observations of what's going to happen to it in the future because I don't know what it's doing now. So I'd have to just say I'll have to do some research on that and ask me next seminar and I will tell you. Okay, what's the usual broker spread for oil, and is it based on points or pips like in Forex? Yeah, of course. I mean, the brokers always quote things in points or pips. Depends on your language. They're the same thing, really. The point movements. So just ask your broker, or they will put on their site, they have to by law, how many points, they charge on the spread. It's generally between 5 and 10. So that's what I'll be looking out for, Pitbull. Do I trade non-farm payrolls live? Yes, I do. I've traded 2 figures a month for the last year live. I'm up over £10,000 in live trades. So when you listen to me, I do the education. When you watch me, okay, I do it live in front of you and I give you commentary, which is quite difficult, but I do it. So everything I say is always backed up, and it's backed up with physical money in a live account. So that's why I have the credibility I do. That's why I also write for FX Street, and I have a number of websites that people like to listen to me, because I back everything up. I'm not a theorist. I'm a real trader that's been in the same situation you have. So I always back things up, and I always tell you guys the honest opinion. I never lie to you, and I never promise you anything. Yeah, I just tell you how it is. So hopefully that's why you keep tuning in and listening. Okay. Yeah, okay, Gam, yeah, that's quite an in-depth thought. You've obviously thought about this quite a lot. So it needs special refinements. Again, the ability to refine things is what makes Brent so easy, because it is easily transportable, and that's why it is the benchmark. But yeah, you're exactly right. If these things are too difficult to transport, the actual costs sometimes outweigh the benefits of what you get from it. So these are things you need to build into your long-term plan and kind of figure that out for yourselves, because you will get an edge if you understand this. But yeah, absolutely, yeah, very, very, very insightful. That very interesting. New ways to extract oil, yeah, okay, yeah, absolutely. Anything can affect it. Anything can happen. Yeah, you can log in to watch, guys. Yeah, I'll tell you what I'll do. As always, I'll get a list of emails after this. So I have some special introductory offers that you all can benefit from following me. So let me send you an email tomorrow and invite you all to come and watch me. And yeah, that'll be fine. No problem at all, guys. I'll send you an email tomorrow. So look out for that. We've got a couple of days for non-farm, so it'll be fine. You've heard professionals don't trade non-farm payrolls. Well, then they're either not professionals or they're stupid. Everyone should be trading non-farm payrolls. And even if you don't trade the figure, trade the aftermath. Yeah, that's what I do quite often. I'll trade the first 5 minutes. What I will trade is the pullback. I will trade the maybe a 50% pullback in the initial move. Again, if you watch it, I'll tell you how I do it. It's not rocket science. What I do is I adapt to the market and I trade of what the market's telling me. Okay? But yeah, non-farm payrolls isn't easy, but it's the biggest economic figure that comes out every month. That's 12 opportunities to get in the back of a big move. So, if I was a professional trader, I'd be in. Don't worry. Yeah, absolutely. There'd be a big spike if there's a war in Iran. Huge. Oil would go to $200 a barrel. Buki, well, maybe you want to take the day off. Unfortunately, I can't take the day off. Otherwise, there'd be nobody trading it and nobody able to watch, would there? Yeah, absolutely, Fernando. There would be a massive spike and it'd last for a long, long time. And the price of oil would be absolutely astronomical. It'd be the end of the world as we know it. It would not be a good thing. Alright, guys. Well, like I said, I'm going to send you an email so you can follow me on my other different paths out in the world. Anything you want to find out that I've done on FX Street, just tap in my name, Steve Ruffley, into the search on FX Street. There's different commentaries I'm writing, different things you can look at. It's been a great one tonight. This has been the best Q&A session I've had in the last 6 months. Yeah, you guys have been brilliant, really, really insightful, and I've really enjoyed it. So it's been great to see you, and I'll send you an email tomorrow, and I may see you on Friday. Alright guys, it's been an absolute pleasure, and I'll speak to you all very soon. Alright, cheers, good night.